Our next guest has been calling for a correction for a while now. Sees a buying opportunity near 4,200. Not quite there yet. Evercore's ISI's Julian Emanuel has a year-end S&P target of 4,450. Joins us here at Post 9. So you've been expecting this pullback.
Not surprising. If you look at the last year and a half since the all-time highs in January, every time rates got too high, the market has started to sell off. And when you think about where we were in terms of returns on the S&P 500 and more precisely on the NASDAQ, which is much more sensitive to rising rates, this is a normal correction.
So how much more does it have to go? Because it does feel like a little bit of a delayed reaction that the equity market is having to the bond market.
It definitely is. But when you think about sort of the psychology around AI that's been permeating really the majority of the last 6 months, and how easily the market rebounded off of the Silicon Valley Bank bottom, even as rates started rising, that tells you there's some buying, that there is more legs. But for us, again, this is part of the rebuilding of the wall of worry, that as long as the labor market stays strong, we think this will be a buyable correction.
Are you on the lookout for falling yields and falling stocks?
So that is one of our sort of flags, where if we do get a turn down in yields, and we think actually yields on the 10-year go back towards 4%, and stocks don't respond positively, that will be a change in the narrative, that as strong as the economic data is right now, the concern will shift to a potential recession. We don't see it yet. We will be watching that very carefully.
But in that case, would you want to buy the big tech stocks, or is it too soon to even talk about that?
It's really too soon, because, again, part of the thesis here is that if you think about it, actually, if you talk to institutional investors, there are core people that hold these names in size, but a lot of them have been underweighted. The public, however, is overweight those stocks, has been overweight those stocks for 20 years, continues to be. If the public doesn't lose his or her job, those stocks are a buy.
All right, but we got 3 months left in the year, and you've got a target that now, percentage-wise, is a decent move higher. So what's going to get us there?
Well, again, so seasonality, as crazy as it may sound, why does the market go down every September? Maybe because we have to put our suits and ties back on, but it works the other way as well. October bottoms lead to fourth quarter rallies. And lo and behold, let's say we get an upside surprise that our government actually figures out how to stay open in the next 30 to 60 days, or the next 30 to 60 hours.
So do you think some of this decline is due to the worries about a government shutdown?
Look, we heard that there's a potential downgrade in the works here. Yields going higher. It's all part of the calculus.
We're reading more about dealer gamma, risk parity, zero-day option volume. Is market structure okay, or are you worried about that?
Market structure is okay. It's different. And actually what's happened is that 0 days to expiration options, because you're closing out your position at the end of every day, has actually kept volatility more subdued than it otherwise might have been. And that will be actually, if anything, a risk mitigating factor as the buy spot opens up.